Well, this week we're reviewing the Deutsche Bank Offshore Trackers. Now, this allows you to get exposure by buying an offshore instrument and, of course, exposure to developed world markets, to world indices, to world exposure there. And, of course, this is through an ETF structure. So, Mike, it's good to have you with us to discuss these. Tell us about the various options we have when it comes to the developed world side of things on an ETF basis.
Yeah, the Deutsche Bank Tracker funds are great because not only can you buy ETFs that give you exposure to all the South African equity markets and bond markets and property and so on, but you can also buy international investments. And the Deutsche Bank ones give you exposure to developed markets like the FTSE 100, which is the UK stock market, the MSC 600, which is the US stock market, Japan, the world product, which gives you exposure to something like 27 countries around the world. And there's also a European product. So you buy an ETF on the JSE, and this directly invests internationally, but you're buying it in rands, and it's very cost effective, and it's an easy way of trading in international markets.
And of course, the first one, as you can see up on the screen there, launched in 2005. And of course, the benchmark is the Euro Stoxx 50. But overall, you can get exposure to the US, you can get exposure to the UK, you can get exposure to Japan if you want to take a position on the Japanese market, and then the MSCI World Index in rands. That's the key.
Yeah, the big advantage with the DBX trackers is they're inward investments. So they trade in rands in the JSE, so you don't need to have a foreign exchange allowance, you don't need to have tax clearance. You can buy these pure rand hedge products on the JSE in rands very cost effectively. It's much more expensive to take your money offshore and much more complex. And so these are a cheap and very efficient way of getting exposure to international markets. And yeah, we will find from our panel, but I think most investors should have a percentage of their portfolio should be looking at offshore exposure.
I think they make great core portfolios for your offshore allowance, and maybe Mike can give us some more detail on this, but years ago there was restrictions on how you could invest offshore. So these were quite innovative in the sense that they came to the market with a rand-based kind of product on the JSE, and it was sort of regulated in that sense, whereas a lot of people used to take their money offshore through various alternative means. I still remember people were investing in containers and all sorts of weird ways to get a dollar-based exposure, and it's very expensive to do that. And this, you know, these products are slightly more expensive than your average unit trust, but try and take your money offshore and see how many layers of fees you go through, and in the end you're owning, you know, Apple, Microsoft, General Electric, these kind of big companies, which are something that everyone should hold in the long run over time. But I mean, that was the key benefit, wasn't it? Is the access to these markets without having to go through illegal channels? Or
yes, I mean, you're slightly wrong when you say that a foreign unit trust is cheaper than the Deutsche Bank products. That foreign unit trust is about 3 times more expensive because they have
a local unit trust.
Local unit trust going into an offshore market. You can buy a unit trust which exposes you to international markets, but then you get into something called asset swap capacity and all the rest, which is quite expensive. These products, there isn't an asset swap. An inward investment just means provided Deutsche Bank has bought this product offshore, they take the foreign exchange exposure.
Correct.
The rest of us just buy this thing in rand. So it's effectively a rand instrument where you don't have to have asset swap capacity.
And that's certainly not, what's not happening in the unit trust.
It doesn't have in the unit trust. So they are cost-effective way of doing it. I'm not decrying unit trusts, but this is a nice, cheap way of doing it, and you're getting exposure to some very good portfolios. It's very few unit trusts can outperform the MSCI 600 index in America, so you can get direct exposure to that index and have an American portfolio.
Let's actually show people what that world index actually looks like. Just look at the table quickly on your screen, and you'll see if you bought the MSCI World Index, that's through the Deutsche Bank World ETF. Look at the companies that you're getting it, and those are basically the top 10 companies that it holds: ExxonMobil, Apple, General Electric, Nestle, Chevron, IBM, Microsoft, J&J, which is Johnson & Johnson, AT&T, and Pfizer. And just to show you some returns, and there you can see some of the returns for these markets. And that's now for every 100 rand that you put into these various products in 2008. And I mean that's the beauty for me here, Mike, is the fact that you can do holistic portfolio construction. You could own active stocks if you really want to, but if you want to have global exposure, you could get it literally by the click of a fingers. I mean, you literally don't even have to worry about any of jumping through any of the loopholes. You could literally just buy an instrument on the JSE and bang, there you've got your global exposure.
A lot of people are scared of buying foreign investments. They say, which shares should I buy? Where should I go? Should I go to some guy in Isle of Man, or should I go to some stockbroker in London, or through the Cayman Islands, or what should I do? This takes away that fear. This just says you can buy an international exposure in a very good portfolio of all the top shares that make up the index of these big markets, buy it in rands, don't have to take tax clearance, don't have to get foreign exchange clearance from your bank, and that's all expensive and time consuming. So you shouldn't be scared of saying, I want to have some foreign holdings in my portfolio. And that helps in portfolio construction, as you say.
And invariably, any portfolio should have global exposure.
Oh, yes.
I mean, it's just kind of, a simple rule.
You are getting the benefit of the rand with these products as well. That's important to understand. But you're buying and selling them in rands, so you're not getting dollars out of this, right? No. But you are getting the benefit of a rand appreciation by holding these.
Yeah, if the rand appreciates as it's done by 20% in the last, couple of months, well, that's your portfolio's gone up by that amount. Yeah. So if you look at nearly all these DBX trackers, I think they've gone up between 24 to 28% in the last year.
Yeah.
The all-share index went up something like 16% over that period. Over the last 2 years, they've gone up by 20% per annum, and the all-share index went up by 10%. So by going offshore, you've not only broadened your exposure, so reduced your risk, but you've also performed very well in the last 2 years. Up until then, you performed badly, but in the last 2 years, it's been excellent.